In our business, it's very hard to figure out what is the most important thing. There is no one important thing. There are many things that an investor has to consider, but the truth is the most important thing is risk. And I believe that it is the job of the professional investor to control risk for the client. The job is not to make a lot of money, because usually the market goes up. Usually it's easy to make money. The challenge is to make money at the same time that you control risk. And a portfolio which has the opportunity to make money, but with the risk under control, is, in my opinion, the mark of the professional investor. So the question is, how do we do that? First, the truth about investing. Most investors cannot see the future better than anybody else, and trying to predict the future will not produce investment success. One of my heroes, John Kenneth Galbraith, said, "We have two kinds of forecasters, the ones who don't know and the ones who don't know they don't know." The truth is the future is uncertain, and yet what is investing but deploying money for the future? If everything you say, as for me, if every sentence you say starts with the words, "I may be wrong, but," or "I don't know, but," then you're unlikely to get into trouble. The way you get into trouble is thinking that you really do know what the future holds, and of course, in my opinion, being wrong. And 45 years ago, somebody did me the favor of explaining to me, gave me the greatest gift, the 3 stages of the bull market. And if you understand this, you're almost ready to become a professional. The first stage, when only a few exceptionally bright people understand that there could be improvement. The second stage, when most people understand that improvement is actually taking place. And the third stage, when everybody believes that things will get better forever. So if you buy in the first stage, when most people don't see a better future, when there's very little optimism included in asset prices, you get a bargain and you can make a lot of money. If you buy in the second stage, when everybody understands that improvement is taking place, you don't get a bargain, you do okay, you follow the cycle, you buy in at a fair level. But if you buy in the third stage, when everybody thinks things will get better forever, and when asset prices reflect a great deal of optimism, you pay high prices, which set you up for substantial losses. So the interesting thing about investing is it's not what you do, it's when you do it. It's not what you buy, it's when you buy it, under what conditions, and at what prices. The key to investing is not buying good things, it's buying things well. And I believe that there are cycles and that they're extremely important to understand. I believe there always will be cycles. I have followed cycles for 50 years. I think I've been able to help our clients by dealing with the cycles. And halfway through writing the book, a thought occurred to me. Why are there cycles? That's really an important question. Why do cycles occur? If the US GDP grows about 2% a year on average, well, why doesn't it just grow 2% every year? Why sometimes 3 and sometimes 1, and sometimes 4 and sometimes negative in a recession? The S&P average of stocks returns about 50%, 10% a year on average, and it has done so now for about 90 years, almost 10% a year. Why doesn't it just give 10% every year? And so rather than thinking of the cycle in terms of ups and downs, which I always did and most people do, I think it's better to think of excesses and corrections. Excesses when things go too strong, and corrections when they go too weak. So, and why do we have excesses? Because of the involvement of people. This is not mechanics. This is not physics. This is an area where people have a very strong impact. We walk in this room, we turn on the light switch, and the lights go on every time. Why? Because the electrons flow from the light switch to the light fixture every time. The electrons never say, not today, I'm tired. They never go in the wrong direction. They never go on strike. And they always do what they're supposed to do. But people rarely, in my opinion, do what they're supposed to do, and especially not at the extremes. And because economies and markets are made up of people, and people have feelings, we get cycles. Now, the next question that's important is the cycles that I've been talking about, are they dependable or not? And the best way to understand the answer to that question is another quote from our friend Mark Twain, who said that history does not repeat, but it does rhyme. Very important. And people nowadays say to me, well, this cycle, which cycle from the past is it like? And it has some characteristics of others, but it's never quite the same. History does not repeat, but there are certain underlying themes that do repeat or do rhyme from one cycle to the other. And if we can learn about them and recognize them, then we can be ahead of the game. So, for example, in my period in this business, I've lived through about a half a dozen important bull markets. In general, they have certain themes that do repeat. And here they are. Too much optimism, too little risk aversion, and too much capital availability. Those three things in themselves are a pretty good recipe for a bull market. And it's pretty hard to imagine having a bull market without them. So these are the themes that we should associate with a bull market, which is to say, a period of appreciation to excess. Now let's talk about the three. First of all, optimism. Most people think, or many people think, that asset price rises are produced by good events. But the connection is not just between events and prices, it's events and psychology. It's events and how they are perceived that produce changes in asset prices. And the role of perception or psychology in the setting of asset prices is extremely important. Secondly, risk aversion. Risk aversion is not a concept that most people think about every day, but it's extremely important. And most people are afraid of losses. That is to say, they are risk averse. For most people, if they make 1,000 euros, they're okay. But if they lose 1,000 euros, they feel terrible. So the losses count more than the gains for most people. So most people are biased towards risk aversion. And risk aversion is a very, very important ingredient in the markets. When people are risk averse, as they should be, then what happens? If they consider an investment, they study it thoroughly. They make only conservative assumptions. They are rigorous in their analysis. They demand a margin, what we call a margin of safety. I want to be sure that if things go poorly, I'll be okay. And they demand risk compensation. If they're going to do something which is risky, they demand an exceptional return as a potential reward. And eventually in the market, fear of missing out takes over from fear of losing money, and then people do bad things. So we have to understand whether the market is based on risk aversion or on risk tolerance. And when it's risk tolerance, because people are excited, then we have to understand that the market can be a dangerous place. Number three, the impact of capital availability. The market is an auction place, especially for a good way to think of it is the loan market. You know, you want to borrow some money, you go to some banks. Each one bank tells you what they'll do to provide you money. But if there's too much capital in the hands of people, and they're too eager to put it to work because they're afraid of missing something, then the bidding goes too high and the price becomes excessive, at which point the prospective return is low and the risk is high. And we want to know that. When there's too much money chasing too few deals, those are the 7 worst words in the world. Too much money chasing too few deals.